Well, ahead of the big auto guys descending on Capitol Hill again this week, asking for a bailout, a guy urging today a timeout. Forget rescues that work only so long. Think tax cuts that work permanently. He's John Taylor, former Treasury Undersecretary for International Affairs, who also, by the way, is currently a member of the California Governor's Council of Economic Advisors. That state, as you might have heard, is now in financial rescue mode. And even Governor Schwarzenegger is saying, I have no idea how we're going to get out of this. No, he didn't say that, but anyway. All right, John, first off, to this idea of a permanent kind of a tax cut. We talked to a congressman earlier, a Texas congressman, who's looking at a couple of months tax holiday, income tax holiday. You go further still. What do you want to do?
Absolutely, you got to go further. In fact, the experience we had with the stimulus package that was passed back in February, where checks were sent to people in May and June and July, huge increase in their income, didn't spend it, basically. It's an illustration of a theory that economists have been talking about for a while. It's the permanent income that's more important. So what that suggests is more permanent tax cuts is what we need, and that's what I've advocated. I
tend to agree that permanent tax cuts are always in order. More people benefit longer term from tax rates they can reliably bet on staying low. But if that were the case, then we would have seen every year the tax cuts we've enjoyed since the president took office, the economy getting strong or staying strong throughout. And over the last year or two, of course, the opposite. What do you make of that?
Well, of course, we've had some heavy hits from the housing market.
Absolutely.
The plunge of housing prices, right? So you got to take those into account.
So you're saying it would be a lot worse if those tax cuts had been allowed to be rescinded?
Recovery would have been worse. In fact, right now, if the tax cuts that are scheduled to expire do expire, it's going to slow down the economy. That's why I've also advocated if somehow the Congress can get together and say, okay, let's have President-elect Obama's tax cuts for those certain groups, and let's also agree not to raise taxes on anybody. I think that would be a good jolt to the economy right now.
Well, he seems to be at least postponing it. The thought was the tax cuts for the upper income would expire immediately. Now they might be allowed to die their natural, preordained death at the end of 2010. What do you make of that?
Well, I think that's also harmful. Right now, you know, if you think about a lot of those tax cuts are on small businesses. Roughly 50% of small business income would have a tax increase in current law, and a lot of dividends, a lot of capital gains, 80% of capital gains, actually. So I think that already is a drag on the markets, people worrying about taxes increasing. Businesses make plans for a number of years in advance. If there was a convincing evidence that even in 2010 those taxes would increase, I think it would be very beneficial to the economy.
Let me ask you what's going on in California there. It wasn't too long ago that Governor Schwarzenegger seemed to indicate he would be looking for emergency relief from Washington. Now that the state is looking at $11.25 billion shortfall, I think the largest of any of the states, he could be revisiting that. What do you make of that?
Well, one of the things you want to look at is how the financial markets for the government that state is working. And those have freed up a little bit since he made those original suggestions. And in the meantime, the big issue in California is the housing market. That's why the state has been hit hardest. California, Arizona, Nevada, Florida, those are the ones that have been hit hardest. And that's because of the housing crunch. It hasn't turned around yet. The boom was out here as large as anywhere else, and the bust has been large as well.
Interesting. John Taylor, thank you very much.
Thank you.